Chapter 3, we're going to be looking at financial statements and cash flows. Specifically, we're going to learn how to compute a company's profit as reflected by its income statement, determine a firm's financial position at a point in time based on its financial statement, measure a company's cash flow, and explain the difference between GAAP and it should be IFRS, International Financial Reporting Standards. Okay, learning objectives continued. We're going to look at computing taxable income and income taxes owed because that will be used throughout our course. We're going to describe the limitations of financial statements and learn how to calculate a firm's free cash flows and financing cash flows. So let's get started right with the income statement. It's imperative we understand the workings of an income statement. It's also known as our profit and loss statement. What does it do? It measures the results of our operations over a specific period of time, a year, a month, 3 months. The bottom line of the income statement shows a firm's profit or loss for a period. So in accounting, we call it revenue. In the common world, we call it sales. I don't mean that in a bad way. Sales are amounts we either bill or receive in cash immediately from providing our product or service. And then the expenses are those outflows that are required for us to pay to perform our business every day. And they're usually services we receive. Well, if we take what we bring in minus what we pay out, that will tell us if we have a profit or not. Now, if our expenses are greater than our sales, we have a loss. But if the opposite, we have profits. So revenue, once again, is money derived from selling our company's product or service. Now, you'll also see on this income statement an item called cost of goods sold, which is really an expense. This is the cost of producing or acquiring the goods or services that we sold. Not to be sold, but that we sold. So if we buy a computer and our business is selling computers, we buy a computer for 100, we sell it for 300, our sales would be 300, our cost of goods sold would be 100. Operating expenses are expenses related to marketing and distributing the product or service. General and administrative expenses and depreciation expenses are also part of our operating expenses. Now, marketing and distribution is directly related to selling the product. General administrative are those indirect expenses that are necessary to run our business but are not contributing to sales as direct as marketing and distribution. Also included on our income statement would be financing costs such as interest and then our taxes that would have to be paid on the profits of the business. So there's an illustration of the income statement itself. So many of you probably have seen one. Some of you do have an accounting background, I know. But if you don't, you really need to take a look at this and practice it and understand it. It's sales, once again, minus cost of goods sold. The cost of producing or acquiring the product we sold is gross profit. Gross profit's what we make purely from selling our product or providing our service. We then subtract those main operating expenses, marketing, selling, general and administrative, and this depreciation, and we get operating income. This is our earnings before we apply any interest or taxes that have been paid. Now, the next thing we do is subtract our cost of borrowing money, which is interest, and we get earnings before taxes. Now we compute our tax based on that earnings before taxes, subtract the income tax, and we get net income. That's what's left for the company, the owners. So there is a actual income statement for Home Depot. As you can see, they have their sales. These are in millions. 67 million would be the number. Cost of goods sold will give us our gross profits. Now, what we can do is compute what we call a percentage gross profit margin. That's where we take our gross profits of the company, 23,304, and divide it by the 67, the sales, 67,977. So what that's saying is that 34% of our sales are left after paying for whatever we sold. Then we subtract those operating expenses. Marketing, general, and administrative are all combined here, then depreciation expense. So overall operating expenses are $17,501,000. We subtract those from our gross profit of $23,304 to get operating income. So this is our income from purely operating activities, also called operating profits or earnings before interest and taxes, EBIT, earnings before interest and taxes. So we kind of look at that number as if everything stays the same, what can we expect to make next year? Now we could compute our operating profit margin, our percentage of profits, operating profits after deducting expenses by taking operating income of 5803 and dividing it by our sales figure. We then subtract interest expense to get earnings before taxes, apply our tax rate to get income taxes, and that will lead us to net income. Net income being $3,338,000. This company's net profit margin is 4.9%, computed by taking the net income of the business of $3,338,000 and dividing it by the sales of $67,977. So when all said and done, the amount of money left for common shareholders of all the sales is about 5 cents on the dollar, or 4.9%. And that's what net income really is measuring here. Now, some companies prepare what's called common-sized income statements. Common size restates the income statement as a percentage of sales. So each item on the vertical line going down is computed as a percentage of total sales for that year. Why do we do this? Well, it makes it easier to compare across companies in an industry. So if everybody computes their expenses and items on their income statement as a percentage of their sales, in the same industry, those percentages should be pretty much in line with one another. So you're able to compare yourselves to others. We already saw that gross profit margin, or percentage of sales that go towards gross profit, is 34%. Operating profit margin, or percentage of sales going towards total operating. And then net profit margin is a percentage of sales going towards net profit. So there are 3 key percentages that we usually calculate and really compare across our industry to other companies. If they're about the same, we're doing pretty much in line with our industry, but if they're different, things need to be addressed. So that is our income statement. The next financial statement would be the balance sheet. Now the balance sheet is a snapshot of a firm's financial position. What kind of assets does the company own? What kind of liabilities do they owe? And what kind of amounts do they owe the shareholders in shareholder equity as of a specific date? Now, to refresh our memory, assets are resources owned by the firm. Things like cash, equipment, buildings, land, accounts receivable, those being amounts owed to the company by customers. Liabilities are amounts the company owes, things like accounts payable. These are amounts that the company, they might have bought equipment or received a service and they owe that money. Notes payable are things like loans that the company owns. Bonds payable are bonds the company owes. Owner's equity is how much the company owes to the owners. So this is where we keep track of the initial investment by owners and then any earnings the company makes for the owners. It's important to remember that transactions in a balance sheet are not fair market value normally. They are what we call the cost price. So what the company's books value, which is what is reported normally on a balance sheet, can be very, very, very different from what it's worth or its current market value. So there's once again an overview, a nice little picture of the balance sheet. Current assets and long-term assets are how we present the asset section. Current assets being assets we're going to use up within the coming year. Things like cash, accounts receivable, inventories are those types of assets. Long-term assets are assets that we're not only going to be using in the coming year in the company, but beyond. These are plant or fixed assets, things like building, land, equipment, furniture, vehicles. And then there might be other long-term assets, such as a special category we call intangibles, copyrights, patents, franchise fee. So those are your typical long-term type of assets on a balance sheet. On the other side, we have short-term debt or current liabilities. These are amounts the company has to pay in the coming year. Accounts payable, short-term debt. Long-term liabilities are due beyond the coming year. So those are mainly your long-term loans and mortgages. Now, if we take the net between current assets and current liabilities, we call that net working capital. So that's the extra we have on a short-term basis. In the stockholders' equity, we keep track of a couple different things. We keep track of amounts the company receives from selling common stock and preferred stock, which are two distinctly different types of stock the company sells. They both represent ownership. The other part of stockholders' equity is called retained earnings. And it's exactly what it sounds. It's the earnings still in the business. Remember, profits are what the company makes for the owners. The owners are entitled to all those profits if they wish them. Normally, they don't take them though, because they want the company to sustain themselves. So they leave those earnings in the business for the company to continue to expand and be profitable. But that's what we keep track of in retained earnings, the profits that are available to be paid to the shareholders. And that is our balance sheet. Always remember this. On the balance sheet, total assets. So assets are everything the company owns, equals total liabilities and stockholders' equity. Why? Because assets can only be financed from two areas, either creditors, which are liabilities, or the stockholders. Once again, current assets comprise assets that are relatively liquid or expected to be converted into cash within 12 months. Long-term assets we're going to be using for more than 1 year. You could tell this is an old timer here because they call this section fixed assets. The newer term is plant assets. Other assets that are neither current nor plant or fixed assets. Now, what makes something a fixed or plant asset? It's a tangible item we're using to produce revenue. And there's some other items that we talked about, intangibles, patents, copyrights, goodwill. There's also things called long-term investments. Maybe the company invests in the stocks or bonds of another company, so they're the owner of those, and we'll be addressing those throughout the semester. Debt or liabilities is money we borrow from a creditor and must be repaid. Debt could be current or long-term, as we stated. Short-term debt typically is things called accounts payable. This is credit extended by our suppliers that we pay in a relatively short period of time. There's another type of short-term debt called accrued expenses. These are also short-term liabilities incurred in the firm's operations but not yet paid, things like salaries. Short-term notes are borrowings from a bank that they'll have to pay in 12 months. Long-term debt is borrowing from banks and other sources for more than 1 year. So it's the amounts they owe beyond the coming year. Reviewing equity. Our shareholders' investment in the firm in the form of preferred stock and common stock. Treasury stock is another item you may see in the equity section. What is treasury stock? It's not a different type of stock. It's usually common stock that has been repurchased out of the market. So it's the company's common stock that's been sold that the company is now buying back. We say they hold that in treasury. And then retained earnings. And there's another picture. So the balance sheet is really our accounting equation. Excuse me. Assets equal liabilities plus equity. And there's an example of Home Depot's balance sheet. You can see it's quite extensive, but it follows the same track as we just discussed. All companies make their balance sheet and income statement in the same exact way. They follow the same rules. If they're in a United States company, they're following U.S. GAAP. So you can see here this company's total assets as of January 30th, 2011, second column, 40,125,000. Total liabilities, 21,236,000, and down at the bottom, total equity, 18,889. But assets equal liabilities plus equity. Now this company also does a common-sized financial statement here, where they take a percentage of each item of total assets. Excuse me. So they're showing you the change of between each year, but they're also showing you the percentage each item is of total assets. And you would do that for every single item on the balance sheet. So it's an easier presentation. You could see what percentage of your assets are current assets, what percentage are plant assets, what percentage is liabilities, what percentage is in equity. So this company's total assets decreased by 752 million due to a reduction in current assets in net fixed assets. Their total debt and equity decreased also by that much due to paying off 263 million owed on accounts payable. They also repurchased stock of 2.6 billion, and they issued new stock for 335 million. And once again, they talk about the common-sized balance sheet. And what it tells us, inventories account for 25% of total assets. I pointed some of those percentages out. Approximately 50% of the company's assets are financed by debt. You could see that by the total debt percentage, and 50% are financed by equity. The debt ratio is one of the ratios used to compute financial risk of a company. It's the percentage of assets that are financed by debt. You take total liabilities divided by total assets, and that will tell you what percentage of assets still have debt associated with them. So generally, the rule is, we're going to look at this in Chapter 4, the higher the ratio, the more risky the firm is, as firms have to pay interest on debt, regardless if they make money or they have the cash flow. That's why we don't really like debt in the company. Net working capital, we already talked about. This is the amount of extra current assets we have after paying our current liabilities for other items. Current assets minus current liabilities. The larger the net working capital, the better the firm's ability to repay its debt. Net working capital can be positive or zero or negative, but it's generally positive. Also, an increase in net working capital may not always be good news. For example, if the level of inventory goes up, current assets will increase, and thus net working capital will also increase. However, increasing inventory levels may be a sign of inability to sell. So we can't just take it at number value. Just because we have an increase doesn't mean everything's hunky-dory. We have to determine why. All right, so we looked at the income statement. We looked at the balance sheet. Now let's look at cash flow. Remember, profits in the financial statements of a company are what we call accrual basis. That means that we record sales when they occur, and we record expenses as they occur, not when we're receiving the cash or paying the cash. So, profits are not equal to cash. We can't make that assumption. That's very important. Accrual basis, once again, is the principle of recording revenues when earned. So when we make the sale, we might collect the cash a month later, and expenses when incurred, when we owe them, rather than when cash is received or paid. So sales revenue on that income statement is cash and credit sales. Inventory may not be entirely paid for in cash, as suppliers may extend credit to us. Remember also, long-term assets, fixed assets, plant assets, are recorded as assets and are not expensed immediately, but are written off every year as depreciation expense. So there's an expense that has no cash involved with it. That's very important to remember. It's on the income statement as an expense, but it's not being paid out ever. So when we're looking at cash flow, we have to look at our sources of cash and our uses of cash. When looking at a source of cash, When an asset is decreasing, we're selling inventories or collecting receivables, assets are decreasing, cash is increasing. When an asset is increasing, we're using cash. If we're investing or buying plant assets or buying more inventory, that's a use of cash. So we got to keep that in mind. When we are increasing in our liabilities, we don't owe as much. We're borrowing funds or selling stocks. I'm sorry, we owe more. When we are borrowing money from the bank or selling stocks, we're getting more money in. We're increasing our liabilities and equity. When we're decreasing our liabilities or equity, we're actually paying money out. So this slide is very important when we're talking about cash flow because our assets are reported in an accrual environment. So we're trying to figure out what's the cash component. So here's the gist how we measure cash flow in an accounting perspective. It's on a statement of cash flow. What we do is we say, what kind of cash flows do we have from purely operating our business day to day, opening up the doors, if we're Home Depot, selling our inventory, allowing for lights, building, and all that. Well, cash inflows are positive amounts. Cash outflows are the expenditures, are negative. We net those two amounts together to get an overall cash flow from operation. The next major area we look at on a cash flow statement is from investments opportunities. Investment opportunities come from long-term assets, things like buildings, equipment, furniture, vehicles, intangible assets. These are called the investing assets. So when we buy more, we're decreasing our cash. Now when we sell them, we're increasing our cash. So we look at the net if there's any of those transactions for a period of time. And we say, overall, what kind of cash flows do we have from our investing areas? And the final area is financing the firm. We already talked about this. Two major ways you finance is through creditors and stockholders. So we look at items affecting those areas. Do we borrow more money? Do we sell more stock? Those are positive effects on cash flow from financing activities. Repayment of debt, buying treasury stock, or paying cash dividends are decreasing cash flow from financing activities because we're paying out the cash. So if we net the inflows to the outflows from financing activities, we'll get an overall net. Guys, those are the three major operations or activities you have in a business. You have your operations, your investing, and your financing. So if you determine the cash flow from each of those areas and net them all three of them together, you'll find out how your cash changed for a period of time, whether it be positive or negative, and it explains the why. And that's why we have this financial statement. So once again, three sources of cash flow: from operations, sales revenue, and labor expenses. Net cash flows from investment, purchasing new equipment or selling equipment. Cash flows from financing, an example is borrowing more money. That would be a positive effect, but paying a dividend would be a negative effect. So we have to know where to put it and how cash was affected by that transaction. If we know the cash flows from operations, investments, and financing, then we can understand the firm's cash flow position better. That is, how cash was generated and how it was used. That's what it's telling us. Now, most accountants prepare a statement of cash flow using the income statement conversion basis. Here's what they do. They say, we already have a measure of operations. We have profit. It's on our income statement. But that's in an accrual basis. We need to convert our accrual number to a cash number. And these are the steps they take to do that. They add back depreciation that's on the income statement to the net income. We subtract any increase in an asset, like accounts receivable or inventory. If it's a decrease, we add it. If there's an increase in a liability, current liability, like accounts payable or accrued expenses, it's an increase in cash. We would add that amount, that increase. And when I say increase or decrease, I mean from the beginning of the year to the end of the year. Okay, so we look at current assets, except for cash, and we say, did it increase or decrease? However the asset went, the opposite effect is on cash flow. A current liability is different. It's a direct impact. So if a current liability increases, cash increases. It's a direct effect. So here's a nice flow chart of all of these items. So we start with net income, which is an accrual profit. It's our result of operations, but on an accrual basis. And then we're going to add and subtract non-cash items, basically, to determine our cash flow from operations. And these are all of the items we use to do that. And there's what it looks like on a cash flow statement. So for Home Depot, their net income we saw was $3,338,000. They had 1,616 in depreciation, which is right on their income statement. We add that back. It was subtracted to get to net income. We're trying to change net income to net cash. If this was a cash income statement, it would have never been subtracted. We didn't pay that out, so we add it back. Now the difference between, sorry about that, what happened over the next part is we look at our current assets and current liabilities to see if they increased or decreased from the beginning of the year to the end of the year. Accounts receivables increased. The impact on cash is opposite. We were just talking about that. So we would show that as a decrease in cash flow. Same with inventories. They increased. So the effect on cash flow is an opposite effect. It decreases cash flow. And think about it. If you buy more stuff, what happens to cash? And we saw that on one slide. Sources and uses of cash. Now, current assets decreased by 103. The impact on cash flow is positive. That's why you see it as a positive there. Accounts payable decreased. So that means cash flow decreased because they have the same effect. Now, we'll net the 1616, the negative 121, negative 437, the positive 103, and the negative 263. So to change net profit from an accrual basis to cash, we need to adjust it by a positive $898, those items we just looked at. So cash flow from operating activities, $4236. And that's how we do it. Now, long-term assets include fixed assets and other long-term assets. A firm may be engaged in buying and selling. So we need to determine what's happening. And when we determine it, cash inflows come from borrowing or selling stock. Cash outflows, repaying debt, paying dividends, or repurchasing stock in the financing and investing area. And there is the rest of their financial area. Here's their financing. Cash inflows from borrowing money. So this company borrowed more money of 22, but paid on their debt of 7. They bought new stock. Okay, or they sold more stock. They repurchased some stock, so that's a negative impact. And they paid dividends out. That's a negative impact. So we net all those positive and negative amounts together to find out how they conducted their financing. And it looks like they had cash outflow. They paid more out than they brought in from their financing. Is that bad? No. Conducted some financing activities where they repurchased common stock for a reason and paid out dividends. They've been able to sell stock. So this company had positive cash from their operating activities and was able to spend it to expand the business and to take care of some financing. It's pretty good. So that's what we just talked about. And that's the end of the cash flow statement. So we looked at the income statement, the balance sheet, and the cash flow. Now, what makes these financial statements occur? And what's this idea of GAAP and IFRS? First of all, the United States follows generally accepted accounting principles, which is GAAP. It's a set of standards and rules established by currently the FASB. Most other countries follow International Financial Reporting Standards, or what we call IFRS. It's a broad and general principles established by the ISBA, International Accounting Standards Boards. IFRS is simpler and allows more room for discretion. At some point, we may switch to IFRS. It's not by 2014. The SEC is actually overseeing this transition. It's slowly occurring. There is no exact timeline that I'm aware of at this point. So we are following US GAAP here. When it comes to income taxes, a corporation has to pay tax, and they usually pay it on taxable income. Okay. Now, this company's taxable income is $16 million. So we find that after subtracting all the expenses except for taxes. We then apply what we call corporate tax rates. And what this is saying is these are the ranges of dollar amounts that are taxed at each percentage. So the first $50,000 of corporate taxable income, I should say, is taxed at 15%. The next 25,000 is taxed at 25%. The amount above 75,000 to 10 million is taxed at 34%. So it all depends on where your taxable income lies as a corporation. Okay, so that's how we compute income tax. Accounting malpractice and limitations of our financial statements. Accounting rules give managers discretionary powers. It's possible that two firms with similar financial performances may report different results. And there have been many cases of accounting malpractice where rules have been broken. Oh, I don't want to show you. There's another slide I should probably have, but we could go on and on with the list. Enron, Tyco, Adelphia, US Foods, WorldCom, etc. You guys can probably throw a few more out there without, I'm just going off the top of my head. So it's important to know we follow rules. We have to. And the effect of fraud on our economy is disastrous, as we saw in the last couple, really since like the late 90s, early 2000s. So we defined in this chapter our different accounting statements, what they mean, what they're telling us, who makes the rules for them. Okay, so I need you to make sure you understand those, do your practice, and ask any questions you may have.